Hello guys, welcome to my channel and I'm Shazra Gazzaz. I'm starting off with my first video today, introducing myself to you. I'm an ACCA member and I'm also a graduate in BSc in Applied Accounting. So I thought of sharing my knowledge with you guys. So today's video is going to be on Introduction to Financial Management. So I'm starting off with financial management and then gradually talk about topics related to financial management. And then also I would diversify into other accounting topics and even ACCA examination paper. So let us get handy with financial management today and learn the basics of financial management and thereafter move on. So let's get started with our video. First slide talks about what is financial management. The first point says financial management is an organic function for any business. Why do I say that? Is because the main objective of any public limited company is shareholder wealth maximization. So this can be in the form of capital gain or even in the form of dividends. So you know that shareholders are ultimate owners of the company and directors act as agent for shareholders, and they are obliged to ensure that the business is performing good enough to generate sufficient profits, right? So keeping that objective in mind, directors should provide directives to make money out of the resources invested, that is the capital invested by the shareholders. Only if we make money in terms of profit will the shareholders be happy and contented, which in turn would keep the stock value pleasing enough, right? So how can the directors achieve this? The answer to this is yes, successful financial management. And that is why it acts as a key tone or a key component of the organization. So managing all the financial resources in business context, both assets and liabilities, either long or short term, for any large or small scale business is called as financial management. So managing assets or liabilities of a particular business, in short, is referred to financial management. So what is managing? Managing means planning, organizing, directing, controlling and monitoring financial resources. So all of this should be done with the aim to achieve the business objective, right? So in other words, financial management can also be called as corporate finance. So I will talk about this further in the presentation when we go further. So these points are good enough to summarize what financial management is. So let's move on with the keyword finance. I was just thinking, like I said before, we know what is management is all about. So what about the term finance? Is it just mere money, or is it much more than money? So I was under the impression, okay, finance equals to money, but it is not that way. Finance is a broader term which involves the study of money. So any activities which involves money in it, or in simple terms, financial activities, right? It can be lending, borrowing, investing, budgeting, saving, forecasting. Any activities related to money is represented by the term finance, and that is why it is called financial activities, right? So basically any activities which comes under financial management, it can be even hedging. So any basic transactions on a financial management is represented by the term finance, and it is a broad context. It has a broad context, and that is why it is differentiated from accounting. So that's why I have given that diagram below saying finance versus accounting, because finance is a broader term. It involves management of resources, right, such as assets and liabilities. So to manage these resources, you need the knowledge on these resources. So what are the resources? Basically, it's assets and liabilities, can be long or short term. So you need the basic understanding of what is assets and liabilities, and that is where accounting comes into play. So accounting is basically recording past transactions in books of accounts. So bookkeeping, right? So it's a broad context. A person, a finance person, when you call a person a finance person, he or she should have accounting knowledge for him to become a finance person. So that's the basics. Accounting forms the basics. So that's about finance. Now let's move on. Finance encompasses or holds the following areas under its umbrella. Like I said, finance is a broad term. So under finance, there are following areas. There are public finance, corporate finance, personal finance, investment, and financial economics. These are a few areas which comes under the word finance. So first we will look at personal finance. Talking about finance, like again, I have just put up these in a whiteboard, the main 5 components of finance. And firstly, I'm going to talk about personal finance. What is personal finance? It is the management of money and any financial decision for a person, individual, or family, taking into account various risks and future life events. So, management of money. So let me just highlight that for you. Management of money. Management means, like I said in the first slide, it's about planning, directing, controlling, monitoring. All these words comes under management. So all these activities with related to money or any type of financial decision which is confined to a particular person, right? Mainly the income generator. So the person who earns money, right? And or other dependents surrounding him, taking into account various risks and future life events. So any decision confined to a particular person or a family is dealing with finance is called personal finance. So I would like to put in some more I will just put in some of the activities like budgeting, right? Budgeting, spending, then lending, also investing, and mainly retirement plans. So that's why the definition talks about future life events. So all of these activities, when it confines to a person or a family, it happens to be as personal finance. So managing all of these activities. So that's basically what personal finance is. So okay, moving on to public finance, it's all about the government's role in the economy, right? How the government is managing its finance on behalf of its people, in large the economy, right? So yeah, so I have just put up these little things on this whiteboard for you to note down if you wish. Public finance is about the study of the role of government in the economy, right? The government's main source of income is tax. So collecting taxes from the general public in forms of progressive or regressive tax, right? Thereafter, it has its expenditure where the government spends on public welfare, education, and infrastructure. When the government spends more than its revenue, right, it forms a deficit. That means the government lacks money to meet its expenditure. In that case, the government has to go for a national debt. The government would issue a national debt and borrow money in order to meet its excess expenditure, right? There are times where the government has surplus, that is excess of income. That means it has more money to spend, right, on other various financial activities or investing on other public welfare activities, whatever it is, right? So basically another point which comes under public finance is about budgeting. Budgeting happens, the national budget happens in every country. That is the government plans its revenue and expenditure for the particular fiscal year. The actual revenue and expenditure, it would vary like in a business enterprise, right? So these are the main points under public finance. Okay, so let's move on to the next component of finance, which is corporate finance. Corporate finance is all about the acquisition or allocation of funds or resources with the objective of maximizing shareholder wealth. So I put that definition for you on the whiteboard for you to note it down if you wish, right? So basically, Why I said corporate finance is equal to financial management in my first slide is because financial management is all about managing funds, right? Or financial resources, in other words, right? So financial management is applicable at a corporate level. When it is applicable at a corporate level, it is called corporate finance. Financial management is also applicable in a country level, right? And managing finance at a country level equals to public finance. So that's why I said financial management is mostly spoken, and we mostly discuss financial management at a business level. So that's why I said financial management or corporate finance, right? So when you're talking at an economy level or country level, we can use the term public finance, right? Okay, so defining corporate finance in a more simpler context is corporate finance is the generation of funds, obtaining finance from both external and internal sources of finance at the lowest cost possible. So note that term, lowest cost possible. The cost of possible should be minimal, cost of capital, right? And also after obtaining it, you're supposed to invest it in suitable investment projects, right? So corporate finance is about obtaining the funds and investing the funds, right, with the aim of increasing shareholder wealth over time. So that's about corporate finance. Okay, another key component of finance is financial economics. Financial economics talks about the study of the financial system, and why this is coming under finance is because in order to make financial decisions, we need to keep in mind macroeconomic perspectives, and that's why financial economics plays an important role under the term finance, right? So let us look into what financial economy consists of. Financial economy consists of the financial market, financial institution, financial instrument, right? So three main components of financial economics. What is financial markets? Of course, it's about the capital market and the money market. Capital market is long-term instruments, and money market talks about the short-term instruments. Financial institutions or banks, for example, and of course financial instruments like securities, bonds, right? So financial economics talks about these three components, and these three components together forms the financial system. So why you need this is because of the knowledge you need to acquire to make financial decisions. You need to have macroeconomic knowledge to make financial decisions. Okay, the final component of the finance is investment. What is investment? Investment means the decision or purchase of an asset, may it be a financial instrument or an non-current asset, for the purpose of return. Because in investment concept, there is no profit. There is no term called profit. There is only the term called return, right? It revolves around the term return. So you get only return in the form of capital gain, or it can be in the form of interest. For investments, you need to know financial economics, that is macroeconomic aspects, and also you need to have corporate finance in place. Corporate finance means what? The sources of finance and successful investment proposals, right? So when you have these two in place, you can make the investment, right? So having secured those 2 points, you need to know macroeconomic perspectives, like I said before. Why did I say that? Because even though your stock market is doing good, right, due to economic recession or due to economic conditions falling, the stock value can fall down at the point of your purchase. So that's why you need to have a speculative knowledge on the macroeconomic perspectives revolving around you, because to make the investment decision, it really impacts on your stock, right? Apart from this, investments talks about security analysis, investment appraisal, portfolio theory, and details on financial instruments, which we are not going to go in detail right now. So those investment appraisal aspects would be taught further in the topic of financial management, right? Okay, moving on to the fifth slide, Chief Financial Officer. Why I'm going to talk about this particular designation here is that we spoke about directors and they passing on directives to the lower management to get the work done in order to achieve company's objective, right? So who is a Chief Financial Officer? Obviously he is a director. He is a director in charge of all financial matters in a business, right? So Chief Financial Officer is responsible for financial management, right? He or she has to make decisions in all areas covered by finance. So what do you mean areas covered by finance? Corporate finance, because we're talking under an enterprise level. We're not going into the broader context of finance. We're only looking into a business level, right? So anything under corporate finance or any activities under financial management, like I said before, investing, lending, spending, budgeting, forecasting, hedging, every decision, financial activity, basically, he has to be in charge for it, right? So simply I put it in question terms: how to obtain money, how to obtain source of finance, what investments to be made, what divestment should be made. These significant decision makings have to be taken by the CFO, right? So to make these decisions, obviously he or she needs the cost benefit analysis. You need to make a decision such that the benefits are overweighing the cost, right? Only then you can move forward with the decision. Obviously a company does not want to move ahead with a decision which has a higher cost, right? Alright, we spoke about decisions, right? CFO has to make decisions. What type of decisions does the CFO have to make? Basically, decisions can be divided into three main components: investment decision, financing decision, and dividend decision making. The decision maker should keep the following in mind before he or she makes the decision, right? It's the macroeconomic factor, financial objectives, associated risk, and hedging techniques. So a decision maker should keep the macroeconomic factors. What do you mean by macroeconomic factors? The economic factors, like for example inflation, interest rates, right? How are the performance of the government's economic policies, such as the fiscal policy, monetary policy, and stuff like that. And financial objectives. Financial objectives means the company's objective. Afterwards, the risk appetite of the company. So the risk appetite means the level of risk the organization is prepared to accept in pursuit of its objectives, right? It represents a balance between the potential benefits you're expecting from a particular investment and the threats the investment is going to bring in, which could change, right? Which could change the entire decision of the company, you can say the potential benefits of innovation and the threats that change inevitably would bring, right? So it is necessary to reduce the amount of risk before any action is supposed to be taken. So that's why we use hedging techniques over here, right? So these three factors should be kept by the decision maker in mind before he or she makes this decision, right? We have come to the first decision under financial management, which is called investment decision, and I have put out the definition in the slide itself. Investment of funds or application of funds on assets, right? So this decision in financial management is basically concerned with allocation of the funds obtained via different sources of finance, right, into acquisition of particular assets or investment in a particular project, right? So it can be both long-term or short-term investment. When it comes to long-term investment, it is basically investment in non-current assets, right? And this is more than 1 year. The tenure of the asset investment is going to be for more than 1 year, right? So that is why that is the meaning of non-current assets. So what do you mean by non-current assets in this context is investing in property, plant, equipment, machinery, or either you're taking over another company, acquiring another company, merging with another company, or simply investing into product development, research and development, product improvement, and so on, right? These decisions usually has a huge cost, and you cannot reverse your decision except at a huge cost, right? So if you're reversing it also, you need to incur that huge loss. So this decision is not a joke. You need to have a lot of effort, lot of planning before you invest in long term or non-current assets. So another important aspect in investment is working capital management. So this is the second type of investment under investment decision, short-term investment. So because short-term investments are basically a prerequisite for a long-term investment, because a business has to survive its day-to-day activities for it to achieve its long-term fortune, right? So a firm should actually invest in short-term assets and liabilities. They should pay out its bill. They should receive money from their receivables. That working capital rotation should go on. The rotation of working capital management should be precise for it to survive, for the business to survive, for it to have a going concern, right? So the slide says investment in WCM is for the day-to-day survival of the business. It is a prerequisite for a long-term success. Firstly, you need to decide how much of money you require to manage your working capital, or that is your short-term assets and liabilities, right? How much of cash in hand you should have, how much of receivables you need to receive, how much of creditors you need to pay out, right? And secondly, you need to decide what source of finance, whether it's a short term or a long term, what source of finance you're going to decide to finance them, or you're going to finance these through overdraft or a trade credit. What type of short term finance you're going to basically use for financing working capital, right? So these are the two main subdivisions of investment decision making, right? Apart from that, you need to come to a conclusion under the investment decision. That is, what is the conclusion you have to arrive is how to balance your liquidity and profitability, right? We're talking about investment here. So when you talk about liquidity, it is about the ability to the firm to meet its bills and the firm's cash reserves to meet its emergency expenses, right? And profitability means ability to firm to obtain highest return with available funds. So if you're holding back cash without investing, you're losing on your profitability, because you have enough funds in hands to pay out your bills, to manage your working capital, but you're not investing, because only if you invest you can generate profit. Same time, if you invest all the funds in hand, you will not have enough cash to meet out your day-to-day expenses, right? So you need to strike a balance between this profitability and liquidity. So the trade-off between these two as accounting concepts is important, and you need to arrive at an optimal liquidity and profitability balance, right? So that's the challenge in investment decision making. You need to invest in long-term investment as well. Same time, you need to have cash in hand to manage your working capital management. How do you strike out? How do you strike the balance between these two aspects? So that's a challenge. So apart from that, when making an investment decision, especially long-term investment, you need to check the viability and the feasibility of the particular project. So the two main factors you need to consider is the cash flow of the project and the rate of return. That is, how much in form of interest, how much of return you're going to get through that investment. So these two aspects you need to consider before you make a long-term investment proposal. So let's move on to the next decision, financing decision, right? What is a financing decision? Financing decision means obtaining funds, or what are the available source of finance for you to meet your investment decision, right? So to invest you need funds. So from where can I obtain those funds? That's the question you need to answer when you're talking about financing decision. So there are two main sources of finance, long-term and short-term finance. Long-term is basically dealing with debt, equity, bonds. Short-term finance is overdraft, trade, credit, and so on. The decision making is to determine the capital structure of the company, because you need to have, again, the conclusion we need to arrive in finance decision is how to strike the balance between the debt and the equity ratio. How to have a good debt to equity ratio. What are the factors affecting when you're going to make a debt finance, or what are the factors you're affecting when you're going to make an equity finance, right? So basically the capital structure of a company equals to owner's fund plus borrowed funds, that is debt plus equity equals capital, because owner's funds means equity, borrowed funds means debt. So you need to determine an optimum finance mix between the ratio of debt and equity. Alright, I put up a few things on the whiteboard for a better picture regarding the financing decision. Financing decision is, like I said before, the amount which you require to invest in a particular investment proposal or a portfolio of investment. It is a collection of investment, right? So the challenge here is to strike the balance, or determine the optimal finance mix, right? Or to determine your capital structure of the company. So to do this, you need to balance cost versus risk, right? So either obtaining funds through external sources of finance like debt, or internal sources of finance like equity. There is both associated cost and risk, right? So you need to do a clear cost benefit analysis between these two before you make your decision, right? Debt usually has the cost of interest, whereas equity has the cost of paying out dividends to shareholders, right? And also when it comes to debt, it is more riskier because the risk is associated with borrowed funds as compared to equity, that is owner's funds, as interest is paid on it, and also you need to repay the capital amount after a fixed period of time. So you can default on these two aspects, and therefore that is called the financial risk of debt, right? So the financial risk when it comes to debt is higher than equity. So but when you're issuing equity, or when you're issuing shares, you need to encounter few costs like flotation cost, the cost of prospectus. So you need to compare that. You need to compare the cost of debt and the cost of equity, right? And also if the cash flow position of the business is quite good, right? If the company is good enough and they can generate sufficient cash flows, right, or they're doing good with the business and they have sufficient revenue, in other terms, they can easily obtain debt finance, right? Because if their financial statement is a healthy financial statement, and if the cash flow is healthy, banks or financial institutions are willing to provide debt finance, right? So if the cash flow of the business is good, debt finance is a good option. And also control consideration. Control consideration means whether the existing shareholders are willing to dilute their control or to retain their control, right? So when you are looking out for a source of finance, you need to see whether the existing shareholders are willing to dilute their existing control consideration, right? So even that factor affects on decision making of whether we are selecting debt or equity. And also, yes, like I always said in my previous slide, the macroeconomic perspective, the financial economics, the capital markets also matters. If there is an economic boom, you can easily obtain finance through shares, right? Because the economy is performing good, share prices are going to be attractive. You can attract quite a lot of finance via equity. Same time, if it is economic boom, of course there are amendments in the policies of economic policies, and interest rates are going to be low in order to ease the economic recession. So therefore debt finance will be attractive. So simple things like this are there when it comes to factors affecting debt and equity. So the solution is you need to pick up that right debt to equity ratio. So that's the challenge in financing decision. So let's move on to the final decision making, that is the dividend decision. So let's look into that. The final decision is concerned with the distribution of funds to shareholders and retaining funds for reinvestment into business. So dividend means the amount of profit which you are going to distribute to the shareholders, right? The divisible profit of a company which you are going to distribute amongst your shareholders based on their proportion of their shareholding, right? That is called divisible profit. So how much you are going to distribute, how much you are going to retain in order to reinvest into the business. So this is the decision which you need to make under dividend decision making. Of course, when you are having higher earnings, you will have a higher dividend payout ratio, because if you are trying to retain your earnings despite your higher profits, right, it would still send bad signals to the marketplace which would impact your share price. So therefore you must strike a balance between there. So that's where the optimal decision making comes in. An optimal decision is anything which maximizes shareholder wealth. So you have to give out a reasonable proportion of your divisible profit to the shareholders, and that's where the share prices are also highlighted, and it would remain attractive for future investors, right? So the amount of dividend depends on the level of earning, of course, yeah, cash flow position of the business, growth prospects, taxation policies, and preference of the shareholders. Of course, I would say that the decision making itself is based on the preference of the shareholders. How much of earnings per share you need to pay out is decided by the preference of the shareholders, existing shareholders, right? And also the cash flow position of the company means how much of cash the company is having in hand. You may make profits, but the cash flow of the company should be healthy for you to pay actual cash to the shareholders. So the cash flow position matters. And also growth prospects. There is a time where you need to reinvest certain amount of profits back into the business, because it is also a source of finance. Without going for external source of finance, you can use internal source of finance like retained earnings to invest back if the business has future growth prospects, and in that case shareholders needs to forego dividend to reinvest back into the business. Okay. So taxation policy also matters, because you know that there are tax on dividends paid, and tax on dividends paid, obviously when the tax tax is higher on dividends paid, you tend to give less dividend, right? And vice versa. So that's also another factor affecting the dividend decision. Why it is important is because shareholders are the owners of the company. They have every right to receive their share of profit for the amount invested, right? And the decision here is how much you are supposed to distribute to shareholders, because if you pay out too much dividend, okay, if you pull out cash out of the business in the form of dividend, right, the business may be starved of funding to invest in growing revenues prospects, right? And therefore optimum payout ratio should be calculated to maximize the market value of the business. So that's about dividend decision. It's quite simple. So that ends the important decision making. Okay, so we have arrived at the summary of the entire session. This is really a simple diagram where I have just put out the main key terms which we studied. A business requires finance. Finance can be long-term or short-term finance to invest. Basically, the business require finance to invest into working capital and non-current assets. So we are investing, you generate returns. These returns needs to be distributed to shareholders in the form of dividends. So That is the main decision making in financial management: the financing, the investing, and the dividend decision making. So I hope my explanation was clear enough for you to get a basic understanding on financial management. So that ends up today's video. So see you soon with my next video. Until then, signing off, Shazra.
Thanks for watching. Like, share and subscribe.